Hi, this is KJ Finn. It is Sunday night, August 19th, 2012. This was the weekend after options expiration, and for me, it was a massive expiration. I lost every single stock position I had was called away, and 80 plus percent of my puts expired worthless. So, very good in terms of I've got a clean slate to work with. I've got positions in I'm short puts in BlackRock, Hewlett Packard, Kellogg's, and Walgreens right now. So I'm very, very minimally invested. All those are pretty small positions. I'm probably 25% allocated right now, and not overly concerned about being so under allocated right now. The market's really been heating up. We've basically run from I think I'd say about 1,200 to 1,400 just in since the end of last year, and I'm okay being under allocated right here. The when I put this system together, it was right around the time when lots of people had suffered some pretty massive losses in the stock market. You know, the both through the tech bubble and then again in 2008. And one of the biggest things I was trying to do was minimize that risk. You know, I didn't want to see my portfolio lose 25, 35, 45 plus percent, just to a market correction. In order to do that, when the market gets heated up, when stocks start becoming fully valued, you have to be under invested. And so right now I am under invested. It's not that I think the stock market is, bubblish or anything right now. I think things are probably pretty fairly valued at this point, but I don't know where the next 20% is going to be. Could be down, could be up. Um, but I'm more concerned about losing 20% than I am about not winning 20%, if that makes sense, not gaining 20%. So, my three trades for this week, and I'm not thrilled with any of these three trades. I'm gonna make them, and they're just gonna be smaller positions. You'll see that they're not even 1%. It's not the double digit gains that I normally look for. Two of the three trades that we'll talk about, are probably closer to a 6 or 7% a year annualized return. But at these levels, I would rather be a little bit safer, a little bit more conservative, make sure I give myself the cushion as opposed to forcing myself to take positions where I'm going to get that double digit return. First trade is Hewlett Packard, HPQ, looking at the 17 September puts for 21 cents. And I know a lot of you are not aboard the Hewlett Packard train, and that's totally fine. If you're not comfortable with a stock, then you shouldn't be selling puts on it. Some of you weren't comfortable with Walgreens. I understand that one too. Hewlett Packard, it's a company that certainly has its flaws, but that's why it's currently priced at about a third of what it was, a year ago. So if you're not comfortable with it, by all means, do not invest in it because, this is a stock that has the potential to lose, to have a pretty significant fall from here. And if you're not comfortable holding on, you're going to sell at the bottom. So I'm comfortable with it. I'm comfortable with the dividend. I don't think they're going to cut their dividend. They're still a profitable company. They've just got some issues to work out in their management and their product lines. Second trade is Clorox CLX, looking at the September 70 puts for 50 cents. This is a trade I had last week. I think I was closer to 60 or maybe even probably 70 cents that I was looking for last week. It's one of the few stocks that's still kind of hovering right around its green yellow pivot. So I'm willing to invest for less than that double digit gain by only collecting a 50-cent premium on a $70 put. As opposed to I could sell the 72 and a half. I think the 72 and a half was selling for a buck 15 or something like that. So I would definitely be getting my double digit return, but I'm losing some of that safety net. And if the market does correct, 10, 15% from here, I'm going to be pretty far in the money on that put, probably maybe even far enough where I can't sell any calls against it, and I've got a pretty high cost basis. So again, I'd rather be safe, sell the 70 as opposed to the 72 and a half there. Third trade is Walgreens, selling the October 33 for 49 cents. That's we're almost 2 months out now from the October expiration. So ideally, for a 33 put, we'd want at least 66 cents. I'm targeting the 49, targeting the put at 49 cents. So, again, not getting my double digit return, but I still want to be collecting some premium. I want to have my money working for me a little bit. I just want to have it working conservatively. If we do get a correction, then there's going to be better opportunities. I've still got most of my money to put to work at that time. But I do want to keep some money coming in because the market can stay here, it can rally. We don't know where the market's going from here, or at least I certainly don't. Um, and so I'm going to keep kind of chipping away with these small positions. There's another trade, and I've already got a Kellogg's 50 September put allocation, and I'm not really comfortable adding to that at this point. I'm fine with the amount of puts that I have there, but I think that's a trade where if I didn't already have a position, I would be looking to initiate this week too. So again, that was the Kellogg's letter K, September 50 puts for about 50 cents. Those are my trades of the week. Feel free to ask any questions in the forums, and hope everybody has a great week.